Hello and welcome to the Investing Master Series. My name is James Boyd. We welcome you on this March 3rd. And markets have been a little red. I've been watching them overnight, so we'll get into that in just a moment. We've got some great questions that have been asked already, so we'll make sure we jump to those as soon as possible. If this is the first time you've been here, we welcome you. This is not a one-off session. We actually meet each week at this time, and I'll share with you some links. You want to make sure you actually bookmark those as well. We also have Barbara Armstrong with us in the chat. You'll see her initials as BA. And so grateful to have Barbara here. And we got many of you here as well. Will, Pia, Thea, Josh Pink, Ricebird, Austin, and many others. Let's go ahead and get started. Welcome. Now, just real quick, Barbara and myself, we do post educational content on X. A couple things that we want to kind of keep in mind is, so when we talk about X, you're going to notice that this page right here, and I'll actually find Barb's, and I'll put that right there in the chat. This was Brent's from yesterday. Let me actually just type in Barb, and right there. So these two links are for the pages for myself and Barbara. We post educational content on there and announcements. Make sure you're following us on X. Quick reminder that also when you go to YouTube, our classes we stream through YouTube, and our channel is called Trader Talks Schwab Coaching Webcast. It's free to subscribe, and that way you can see all of our content and also search for different content on our channel as well. So quick heads up there. Now, if you're just joining us for the first time and you say, hey, you said you actually teach us on a normal series, where can I see maybe a prior list of classes that you've really taught before? Well, the previous, let me pull this up just real quick right there. So this link right here, there you go. That is the playlist of topics that we have discussed as of lately. So example given, if we pull this up and say, what have you talked about lately? Okay, well, strategies for market volatility, kind of sounds like recently. Tracking current market conditions, interest rate drops, which has been pretty interesting. As far as the movement in interest rates, tech stocks under pressure by yields, where now? And we also talk about protection, collar strategies, and also potential income and downside protection. We try to bring up the stuff that's the most relevant to the markets. So that link that I just sent to you in the chat, make sure you bookmark that. You can actually go back and watch any of those classes. They're just posted right there on YouTube. Now, just real quick as we hop right in, remember that when we talk about examples, they will be stocks and options. As we talk about long synthetics in some key names here today, understand that we're going to try to trade in a bullish direction, and we're going to talk about why, okay? And we're going to talk about why the certain stocks and which ones maybe are not the examples we're looking for. We'll talk about that. And so as we talk about options, remember that options carry a high level of risk and are not suitable for all investors. The information we talk about is for general informational purposes only. Also, our examples would be done on the Paper Money software application. And when we talk about investing involves risk, including loss of principal. And also remember when we talk about, let's say, short options like cash secured puts, those can be assigned at any time up to expiration, regardless of the in-the-money amount. Now, also quick reminder for some of you that are maybe the first time here, we welcome you again, and all returning users. You can go to schwab.com/events. For any Schwab client, we actually also have live events. One live event that we want to focus on just right now is the Denver event right at the Gaylord Rockies Resort, March 27th, and the 28th. First day technical analysis, second day option strategies. It's free. If you're a Schwab client, you can just go to schwab.com/events and register. You said, James, I'm kind of more interested in maybe different topics like advanced options. That'll be done in Dallas, the April 10th and 11th. And also, if you say, I don't live in Texas, I don't live in Colorado, we're going to be also on the East Coast as well, April 17th and 18th. That's technical analysis and option strategies. Join us. Now, let's actually go ahead and take a look at the market right now. And I want to kind of show you something, and I want to slide this over, okay? So first off, if we kind of take a look at, let's say, let's pull up this first. And what I want to do is I want to pull up the SPX. Now, this chart that I'm going to share with you, okay, let me click on share, and I'm going to put it right in the chat. Now, if I click on that right there, you're going to now see that that is in the chat. If you said, hey, can you give me these charts that we're going to show? I just put them in the chat. You can bring them up on your side. So first off, we've been saying for, I think, about 2 weeks, the market, when I say the market, SPX, is neutral at best. It's been more sideways. We said that it's not really the market that's per se going up to breaking new highs. It's individual stocks. We are in a stock picking market. The index, if you go back to, let's say, December, has been more neutral-ish, okay? Now, with the news lately that we've actually seen between, you know what I'm talking about, there's been some downside pressure where the market is absorbing that new information and how it might play out. Now, when you wake up in the morning, I went to bed at 3:30, okay? So, I mean, someone had to watch the Asian markets and the European markets open. I mean, why not? But if we take a look at this, I mean, if we wake up in the morning and the VIX is, let's say, at the top of the watch list, it kind of tells us, hey, there's currently and forecasted to be volatility in the marketplace. Now, we said yesterday and days before that when the volatility goes up, you sometimes have a very small window to be bearish overall. Now, even back, let's say back in March of April of last year, that VIX went up to 60. It's abnormal. The higher it goes, the less probable it becomes that it can stay there, okay? Now, here we are. We're actually here at 26, 27, actually hit 28 today. Now, you got to ask yourself, if you had to historically taken bearish trades on the market, how would have those trades turned out? You had a very, very, very narrow window to actually be bearish, the market. Now, it's not a bad idea that someone says I might put a hedge or something like that, but you just got to understand that volatility doesn't last forever, and that's why some people are very careful with that strategy, okay? Some people, they like to look for things that might have been pushed down where they're trying to get in those names. I want to kind of focus on some of those here today. Now, that does not mean that we're blind to certain stocks that have actually pulled back, and we'll talk about that. The one thing I want to kind of make sure is when volatility goes up, of course, stops are important, and we talked about that yesterday. What are potential sell signals? Okay, and we've talked about that quite a bit too. The other one is application of protection. Well, what are we talking about there? That could be like callers, it could be buying a put on the stock, etc. It could also, for example, be rolling, let's say, the caller positions, okay? And also maybe bearish positions in general on certain names or the S&P as a potential hedge and so on. Those are a couple things. So when that volatility is going up, that's probably what the investor is focused on. Now, what I want to do is when we take a look at, let's say, just real quick, go back to, let's say, the SPX, we've been seeing that in the short term, we're below the moving averages. These are whole moving averages, the 10 and 20. We're now below. And you're going to see that in this case, when we take a look at this, all we're really kind of doing so far is we're just kind of breaking inside some longer term range. When you go back and look at where we kind of fallen from at the very high, not a whole lot. If we look at kind of where this is now, we've fallen back. It looks like it's down 30%, but it's down 3.44. Doesn't really, I mean, 3%, okay? Yeah, I mean, not really material yet. Now, if we go down to the low, where was that the low? It was down, it crashed down 4% on the index. Even then, it doesn't really seem like a whole lot. So it's been kind of a grind to the downside versus just a quick drop, okay? Now, the question was asked, how do you kind of know that you might be at some capitulation areas? Does anybody know the answer to that question? Now, I've done this for 30 plus years, and I could tell you it's capitulation, okay? Well, it's usually when there's not any place to really invest. In other words, even some of the areas that should be going up, they're not going up. So when the markets go down more and more and more and more, the correlation of most assets become closer to 1. So example given, if I were to pull up, let's say the sectors, example given like energy, IXE. IXE is the communications, Dow transports, transports in general, industrials, financials, utilities. You're going to even see gold. Gold was doing pretty decent until 1 Mountain Standard Time, 3 p.m., 3 a.m. Eastern, and then it just broke apart, okay? What you're going to see is the point is that when all of them actually, there's nowhere to hide. And so the only place that we can really kind of see that when we look at all of them, they're not all going down the same percentage, and not all of them are actually on the week basis really down the same. Stocks is the worst. Base materials is right behind it. Discretionary is down 1.96%. Healthcare down bigger today, down 1.8. Most of that came from today. So when you look at this, it's when most areas are being sold. So my point in bringing this up is when you go try to look for like places to get in, you might say, well, they're all down. 90% of them are down. The more that are down, you probably know you're more at that crescendo capitulation moment. Also, that would actually be when, in this case, when the VIX was probably, the higher, the stronger the potential setup, okay? Now, what I want to do here in this case is, now, if we kind of looked at the market right now, let me repeat what I just said. The higher that the VIX goes, the greater chance for capitulation. Now, some people might say, could I like to go bearish? You could. Some people might want to say, I'm going to go bullish. Now, what I want to do in this case is I want to take a look at a couple stocks. I want to start with the stock George Tom. Now, you take a look at this. Target has really been going through, let's say, a recent upward trend. We saw that the stock recently had earnings. That earnings was 244 actual. The estimate was 217. Now, the investor in a more volatile market, the most bullish strategy you can do is buying shares of stock. And a lot of times investors say, look, I don't want to buy shares because I want to be very protective of my capital. But we know when you buy shares, it really has the highest delta. Highest delta actually means your profit loss is the most sensitive. You go up $1 and you have 100 shares, you have an unrealized profit of $100. Stock goes down $1 and you have 100 shares, you actually, in this case, would have $100 unrealized loss. Now, when the market becomes more volatile or VIX is higher, you actually have the opportunity to maybe use options. Now, example given, what I'm going to do is I'm going to go to the trade tab. And what I'm going to do in this case is I'm going to go look at the options. Now, some of you might say, James, I've never done options before. Now, I remember the first time I ever traded options. The first option I ever traded was on the Nasdaq. I was by myself, never had any coaching. I was scared to death. I think I was even sweating when I bought that long call on the Qs back 25 years ago. Now, if we take a look at this, with options, we can pick the expiration. Now, some stocks have have options in general. Second, some stocks have more expiration due to demand. Now, if you take a look at this, what you're now going to notice is we're going to go to the 17 April with 45 days remaining, okay? Now, you're going to notice on the left-hand side, calls. On the right-hand side, puts. And now what you're going to see is down the middle of the page, we have the strikes, okay? Now, if we took a look at this, we got to understand that with more volatility in the market, the spreads on the options tend to widen. Got to understand that, right? Not all, but we just need to understand that that could be a risk there. Now, if we looked at this right there, 755 bid, 820 ask. If we buy the call, this gives us the right to buy the shares. Think of it as you're putting the stock under contract at 115. You have the right to buy. You don't have to buy prior to expiration, but you have the right. Now, if we go over to the put side, if you decide to say, hey, look, I'm going to sell, let's say, the 115, well, you're obligated to buy the shares from now until expiration. So when you buy the option, you're long. When you sell the option, you're short. Long, you have a right to exercise that right, and you're short, you have an obligation to buy the shares at the strike price. Now, how would you bring this up in combination? Well, we're going to right click on that 820. We're going to go buy, and we're going to go to, in this case, where it says caller synthetic. Now, if we go caller synthetic, what it's going to do is it's going to buy the shares itself, buy the call and sell the put. Now, I'm just going to show you this first off. If we do this, if we do the exact same strikes, the 115 call, the 115 put, how much is it going to cost out of pocket? Well, answer $3.80, or in other words, $380. Now remember, we got the right to buy the shares at 115, but that right is not free. You're paying $380. So the break even in this case is 115 add, okay, 380. And now we see the break even is at 118.80. And where's the stock now? Well, the stock is at 118.32. So we need the stock to go up a whopping 48 cents to break even. Now, how many of you in the chat are thinking, man, with the market more volatile, I'm scared to get in? Now, I think most people say, it's me, okay? Well, the first thing is you can change the strategies, okay? Now, I am not a golf expert, okay? But if you played golf, in the golf bag, there's different clubs. Why are there different clubs? Because I'm not going to hit any of them straight, okay? And it doesn't matter which one you give me. Now, the biggest thing is with golf, each club kind of has a specific intent. That's the key word, intent. It doesn't mean it's going to happen. Now, the biggest thing is with kind of option strategies and golf clubs, they kind of have a different intent strategy, right? Now, in this strategy, we're trying to have a delta of 1 or 100. It's mimicking stock-like movement. The difference here, we don't have the claim to the dividend. 2, we have an expiration. 3, we actually have the bid-ask spread on the call and the put, okay? And the 4th, we have the obligation to buy the shares at the 115 strike price, irregardless if it was in the money. So someone would not do this strategy unless they said, I don't want to own the shares at 115. So you would never, if you really understood what you're doing, you would never sell the put if you said, I don't want the shares. Are we good on that? Okay, so you sell the put, you're on the hook, so to say, to buy the shares, irregardless if it's in the money, meaning stock price is below the strike, okay? And it doesn't matter if it's expiration, okay? We're talking about before expiration that could happen, meaning you become the buyer of the shares at the strike price. Now, what we're going to do in this case is let's put it in the paper money account. How do you really learn something? You paper trade it. Now, back when I got started, back before the Vietnam War, at least it seemed like that, American Online dial-up internet, that's when I started. I think the biggest thing is, we didn't have paper money. You guys and gals, you guys are lucky, okay? Now, I'm going to right-click on that call right there, buy. I'm in the paper money account, PM, paper money, simulated trading. We're going to go buy. We're going to go caller synthetic. Now, when we do this, there it is. This is exactly the same that we saw before. Confirm and send. And now what I'm going to do is just going to bring it up. Now, notice what it's doing. If I put that right there, it shows a commission of $1.30, okay? And there's the total cost of the trade, including commission. If we send that order, let's kind of use this as an example template we're looking for stocks that are really bucking the trend of the overall market. We got to ask ourselves the question, why is that going up? Why, when the market is sold down just 3.4%, why is Target still up? A couple weeks ago, we kind of said that the stock was kind of trading as if there might be some motivated investors to try to help the company or the board make some different decisions to become more competitive with Walmart, Costco, etc. That stock is actually being up quite a bit. Now, the one thing I want to kind of say is if we also go back is, can we double check and let's kind of see what is there liquidity on just a couple of the strikes, or is it kind of all over different strikes? Okay, so let's be clear on this. The volume is today, okay? So when we look at 108 contracts for the 115, that could be someone bought 50 and someone sold 58 for a total of 108. They're not netted off. So they're not netted off. So if you buy 108 and I sell one, hypothetically, it's 109 now, they're not netted off. So the higher the volume, the more activity or demand. Now, the open interest, that's the number of contracts that are open, that are open still and unexercised. The point I want to bring up here is that this is not just on one or two strikes. This is kind of down the line on different expirations. It's on the call side and the put side. Now, is that a good thing? Many investors would say, yeah, it's kind of interesting. Super quick, if we pull up, let's say the March, what does that look like? It's not as consistent as what we see in the Aprils, okay? Now, I want to go back to just real quick, one other stock, okay? Now, if we pull this up for just a moment, I know some of you are thinking, James, let's go back to the market. What does that look like? Well, the Nasdaq is kind of in that bottom of the channel that we've had drawn. If we pulled up and said, well, what's the small caps doing? Small caps trying to hold on, okay? Trying to. And if we go back to the Dow Jones, what is it doing? You'd probably say that's the worst, okay? And this does not help typically when that US dollar, which by the way, if you said, what is this kind of showing? Now remember, if people are saying, look, I want to get out of, let's say, paper assets like stocks, they might want to go back to cash. Well, if you're here in the United States of America, our cash is the US dollar, okay? And so if that chart is going up, there is more demand. Well, if you actually get the US dollar to go up, you kind of, some of those Dow stocks that sell abroad, international markets, it makes our products more expensive for them, okay? Now, it's not so immediate, but it's really over time that those prices change, okay? Now, I want to come back to a second example. One of the other stocks that's kind of been interesting a little bit has been Netflix. Now, I want to kind of take that next step here. Let's say the investor said, where do we see the support level? So if I were to ask you that question, where do you see that support? And let's imagine that the investor says, look, I want to be bullish. I don't want to buy shares because hey, if we buy shares of the stock at $96 and the stock goes down, I have a high capital investment, and at the same time, the stock can go to zero. Some investors don't like that. I want to kind of talk about how we could actually cut the risk on this. Now, if we take a look at this, what I'm going to do on this is I'm going to go, if we said, where do we see support? Well, the support level that we can see is probably right around, let's say, $95, $93. Somewhere in that range, 93. If we kind of said, where's that intraday low where we were just 2 days ago? It's right at 94, okay? So now here's the thing. This might shock some of you. The first goal is not to make money in the stock market. That's the second goal. The first goal is to protect your capital, okay? So when markets become more volatile, you're thinking, how can I protect my capital? And then look for trades that kind of have maybe an interesting reward risk setup, etc. Now, what I'm going to do in this case is, let's say the investor said, James, when we talk about the short put, you said the risk was A, assignment true. The second is we could be the buyer of the shares at the strike price. and the stock could fall all the way to zero. That's true. Now, if we look at this, well, how could we actually kind of alter that? Well, it's in what we did in our previous classes when we talked about this strategy. Number one, we're going to go to the paper money account. And what I'm going to do is, and again, the purpose of this, let's go to the Netflix. And let's go to just real quick the put side first. So if we said between the call and the short put, which one is more aggressive? Which one has greater risk? The answer is the short put. It's the obligation. If we lost 100% of what we paid for the call, it's just the premium. So we could lose $650. The premium. Okay? Well, if we sell the put and we become the buyer of the shares at expiration or prior to, the stock could go all the way to zero. Now, likely, maybe not, but it could. Okay? Now, what we're going to do in this case is we're going to buy a put below. So when you sell the put, you're the buyer of the shares. When you sell the put, you're the buyer of the shares. When you buy a put, you're a seller of the shares. Okay? Now, what I'm going to do is we like to go look at the delta column for what is the probability. So when we look at the delta, it has two meanings. I like to think of it as it's a translation. If the stock went up $1 or down $1, that's a stock movement. How much do the options move by approximately? The answer, about 37 cents. This is where that leverage comes in, right? So now the second meaning is delta. What's the likelihood of the stock being, in this case, we're on the put side, below the strike by $1? The what? The stock is below the strike at expiration, 94, by a penny, I should say. Now, in this case, what you're now going to notice is we're going to sell the 94. Now, in our examples, to be consistent, we're trying to look for, let's say, examples where the delta is between 30 and 40. That way, we're trying to get a little decent credit, okay, but also having some probability as well. We're going to right-click on the 94, and then when we actually buy the put, why are we buying the put? Well, because we want to have a right to sell those shares, just in case, okay? Now, if we take a look at this, our example that we're always consistent on is we are looking for a strike that has a delta 10 or less. Why? Well, because it wouldn't take a whole lot to probably buy those puts. If we buy the 78, there it is. And what it does is it also, since it doesn't take a whole lot to typically buy those, it still leaves us with a decent credit. So if we said, well, what's the max loss on that trade? Well, notice the risk is not as high as the previous example. The risk is $1,266. That is max loss. So you need to understand something. If we went out here and just said we're going to buy 100 shares of stock at $97, the risk is $9,700. But in this case, the buying power factor, or the max loss, is $1,266. So now the problem is that's a cap gain strategy. The maximum, the credit, that's the maximum profit. The maximum loss, $1,266. And that happens because it's just taking a look at the difference between the strikes less the credit. So this side of the trade is not the unlimited upside. The unlimited upside comes from the long call. Now, when we actually come back to this, we're going to go single order. First triggers SEQ. All that is saying is do it in sequence. Okay? Sequence. First, get into that short, wide put vertical. Why do you call it short, wide put vertical? Because usually if we're going to do a short put vertical, those strikes would be closer together. So if someone said, I have a short, wide, put vertical, what am I thinking? I'm thinking they're doing like a cash secured put, but they actually have downside protection just in case. Okay? Some reasons for that. Now, how many of you have ever been in an IRA and said, I like to do cash secured puts, but it just takes so much money? Well, this is what some investors might consider is, how can I buy a put to decrease how much money I have to set aside? That's the point. Now, we're going to go to first triggers SEQ, and we're going to come back to the call. Now, remember, that call gives us the right to buy the shares at 96, if we did the 96. When we look down the open interest, we're going to see that it's not just on a couple strikes, it's all the way down the page. Most of that activity is right around the 100. Now, we got to ask ourselves the question, why in the world has Netflix been able to stay up? Now, here's what you got to understand, okay? There's a lot of people that even if the market goes down, they're not going to go bearish. When they get paid on a bi-monthly basis, example given, they have money that's put into a 401k, different type of investment account, whatever. And irregardless of where that market is typically, they're going to try to dollar cost average. They're going to try to build a portfolio over time because they're not investing for the next week. They're not investing for the next month. They're investing for the next couple quarters, years, plural. Don't ever forget that. The bulk of investors are not bearish. The bulk of investors, pensioners, future pensioners, etc., they're bullish, okay? They're going long-only bullish strategies typically. Don't ever forget that. I'm not saying that bearish trades can't happen, but that is a minority, okay? Now, if we take a look at this, what I'm going to do is I'm going to add that bearish position. How do you add it? Well, once we take that first triggers SEQ, we're just going to left click right on that call right there. Left click, and it adds that row right there. Why is it in green? Because it means we're buying. Now, I want you to kind of note something here. The bid was 625. The ask is 640. Could we try to chisel down that price a little bit? Maybe 635. Yes. And I put it down just a little bit, 635. Now, when we bring up this order, is there a maximum loss on this short put spread? We pulled that up. Yes. Is there a max loss built into this? Yes. You could actually lose 635. Now, if we added up and said, what is the grand total of what this position could lose? It's less than $2,000, which is a lot less if you bought 100 shares of stock. Okay. Now, we're going to go confirm and send. Now, notice for the spread itself, the commission is $1.30. To buy that call, 65 cents. Grand total, $1.95. The buying power effect represents if the stock, example, let's say, fell down and was below all strikes at expiration, the max loss, $19.01. $1,901. Okay? Now, we're going to go ahead and send that order. And we're going to look and see if it can't go to the upside. Now, the whole idea is if you look at this, with this gap that we've actually had as of lately, stock has been able to stay above that, okay? Now, when this stock, for example, has been able to hold that gap, we might ask ourselves the question, what's the path of least resistance? Well, the path of least resistance, if this stock went to the upside, the next level of resistance above us, I'm going to just draw a line, flat line, the second line right there, the third line really right there. These might become levels of resistance. This is where some investors might say, look, I'm going to try to take some profit off the table. Okay, now just real quick, there's some questions and I want to get to those questions, okay? So let me first explain to you, let me go back to, now, the one thing that I don't think we maybe talk about enough about, when there is volatility in the marketplace, there's three main companies that really might potentially benefit from that market volatility. example, and I'm going to answer two questions in one. Number one is the CBOE global markets. What do? That's funny. Now, if we take a look at this, it just so happens to be that they do trading, clearing, investing solutions. Oh, look at this. Options. Okay. And so multiple asset classes, equities, derivatives, and currency, FX, etc. ETFs, ETNs. Did we say everything almost? Okay. So when the market becomes more volatile, there could be more buying and selling, buying and selling, buying and selling for whatever reason. And some companies might benefit from that volatility. Now, CBOE, the reason why I'm pulling this up is the question was, what is this green dot? The green dots are signifying what we call a bullish bounce. The acronym, we call it, is close above the high of the low day. And this is kind of helping us identify that it's doing a bounce trade. Now, let me just share this with you again. I'm going to share the grid. Now, some of you might say, hey, I didn't even know. How do you even put this on? Now, Faye actually gives me the next one. I'm coming. Okay, going as fast as I can. Now, here's the thing. I sent to you in the chat a couple of these charts. These are the ones after 30 years that I think are extremely helpful. That when someone is investing, these tools, it's like a hammer, a crescent wrench, a screwdriver, et cetera, et cetera. If someone doesn't have some of these basic tools, man, tough. So what we're going to do is going to go up to the setup at the top right of your platform, open shared item. Okay. Now, if I click on that open shared item, I'm going to copy and paste back what I sent to you in the chat. Okay. Here it is. You'll see it in the chat too. Now, when we go preview, you're now going to see that, okay, preview, it's loaded them up. Let's import these charts into your platform. Well, now if we say import that, you're now going to see that it comes up with some mini charts, and you're going to see that they're right here. Now, you're going to notice that they are similar. We call the charts that we look at, we call it the package of charts. And if we said, well, how would I save this? Good question. Now we got Barb with us here. Okay, took silver in that the men's hockey. However, the Canada took gold in the women's curling. That's all that matters. Okay, I mean, so we're split. Okay, everyone's a winner. Now, what I'm going to do is, if I bring this up, how do I save it? We're going to go down to where it says Save Grid As. And I'm going to really just call this, if you don't mind, Canada. Okay, Canada charts. All right, we can call it whatever we want. Save it. Now, what I'm going to do is, if I go back to that, you're going to see that right there, Canada charts. Now, you're going to see on this that there's like a back arrow, there's a forward arrow, et cetera. Yeah, so when I go forward, there's different charts to look at for different reasons. Okay. So I'm just going to go back to that first chart, but that's how you put them in. All right, now let's go back to something just real quick. And I do mean that everyone is a winner. Now, Nasdaq, the other one, now let's kind of use this as an example given. If I were to ask you the question, where do you see resistance on this chart? What would you say? Now, what you're going to see is in the Nasdaq, you do not see as much, okay, maybe in terms of like a bullish trend as CBOE itself. You just don't see that. Now, I'm not going to, if you looked at the third one, which I didn't see if someone said this, but if you did, congratulations, CME. Okay, more volatility in the marketplace. It's not bad for everyone. What does CME do? Well, it just so happens if we go to analyze, we go to fundamentals, they do trading of futures and options contracts worldwide. Products based on interest rate, equity indexes, foreign exchange, agriculture, commodities, energy, metals, fixed income. Did we say everything? Oh, it seems like almost everything. So if we kind of said, look, CME and CBOE, they're stronger. Nasdaq, if we pull this up, let's go look at this and say, what is it doing and why is it lagging a little bit? Now, it still has some similarities, but what financial products, okay, intelligence, solutions. You're just going to see that it doesn't look like it does. They still do equity derivative trading, clearing, fixed income, currency, but it's not as strong as the other ones. Now, sometimes people like to, for example, trade maybe what has been lagging to something that could start to go up. Now, the last earnings that we had on this, you're going to notice that stock went down. Now, since that stock went down, the stock has been recovering. If we said, where do we see most of the touches? Well, most of those touches have really been right around 86 and change. Now, let's take the next step. When someone does a long synthetic, do they have to get in both the long call and the short put at the same time? Answer? What is the answer? Oh, no, they don't have to at all. So wonder if they actually said, you know what, James, I want to try to. Now, we need to verify. We cannot assume, oh, it's a publicly traded stock, there must be options. We don't know that until we check. We go to the trade tab, we're going to pull this up. And what you're now going to realize is not really. When we look at the open interest, we don't even get 100. Now, I'm going to show this in compare and contrast. So, in most of our examples, the times when it's probably not is if we're seeing a bid-ask spread on the option greater than 20 cents, probably not as liquid as we want, okay? We got 185 bid, 310 ask. That's not even close to 20 cents. And you look at this, in the entire world, you get 3 contracts. It could have been one person, okay? Now, if you come over here to the call side, those don't look much better either. So are all stock examples of options? The answer is no. Example given, Nasdaq. So why do people go CME? Why do they go actually the SIBO? That's probably where you actually had more liquidity in the stock perhaps, and maybe the options in general. So Nasdaq itself, we're going to do this as a stock trade. So this is where someone might make a comment and say, well, if I know about, let's say, options, I would never do stocks. We would never say that, okay? Because not every stock has liquid options. And the reason why someone might want the stock is there's not an expiration. The reason why they want the stock is if they buy 100 shares, they want to have the potential upside gain of $1 if it goes up times the number of shares, or down $1 times the number of shares. They want to have more sensitivity on the direction of the stock. Now, if this was more liquid and we could sell the put by itself, we could just take one side of the trade. If it bounces to the upside, we could add the long call. I just want to point that out here. What we're going to do in this case is, and this is very important you understand this, when markets are more volatile, do not feel like someone has to take a full position. What do I mean by that? Well, let's say in a normal market, you would say, hey, I normally buy $5,000 of stock every time, for example, I get in. Well, the more volatile that the market is, you might kind of chop that up a little bit. You might say, hey, in a more volatile market, there's not just going to be 1 or 2 entry signals, perhaps. I'm going to spread the capital, and I'm going to try to dollar cost average. Guys and gals, this is very important, okay? There's nothing worse than when you go all in only to see the price go lower. The problem, you don't have any more money because you shot all of your capital in one entry. Have you ever been there? You know what I'm talking about? Okay, someone explain to the other person if they don't. Now, I'm going to go buy custom with OCO bracket. So let's do a stock trade. If you said, hey, where might the target be on this? Well, if we go back up, if we continue to see the volatility, some of these companies like SIBO, Nasdaq, CME, they might potentially have higher revenue from the trading, right? We're going to put a target right around $98, which is the prior area of resistance. We'll mark that. If we said, well, what about the downside? That downside is really right about the area. If we said the downside, the lower end, 82.69. Now, if we take 82.69, last example here, 82.69 less 2%. Well, that's going to be 81.03. How do we know that this is a stock trade? Because it says it 3 times. Okay, stock. There's no expiration, there's no strike. Now, we're going to take dated GTC for the target, good till canceled, dated GTC for the stop. Now, here's the deal. In the market, just like if you're trading golf, you might not want to trade or go play golf with one club only. Okay? And you might say, look, in the stock market, I might want to be aware of different strategies given different market conditions. And so the big thing to actually remember is come to each one of these sessions each week. That way you could actually get an idea of maybe is it more income? Is it more value? Is it more growth? And that can be dependent upon volatility and or trend and momentum in the market. Now, if you have not subscribed to the Trader Talks channel, just go to right on your screen down the bottom left. If you have not subscribed, just click subscribe. It's free, okay? We post our classes right on YouTube. You could search for prior classes right there as well. Now, we have Barbara Armstrong with us. And let me send this out to you. Barbara is going to be teaching later today. She teaches a class called Getting Started with Technical Analysis, okay? That'll be coming up at 2 Eastern. Now, if you look at our next class right after this, Getting Started with Options by Cameron May. So we have different classes that we teach throughout the week. Join us in these sessions. If this is your first time here, we welcome you again. Join us each pick a class you like and come join us, learn, okay? Now remember with what we talked about today is done for example, illustrative purposes only. And this has been the class on Investing Master Series. I wish you a great day. Stay tuned for Cameron May coming up next. Bye-bye.